Hi, I'm Keith McCullough. Welcome back. Today I want to talk a little bit about getting beat up yesterday in the market. Obviously the market went up and I'm net short the market, so I need to kind of go through that and review where I stand. I think it's a really important time to differentiate what happened yesterday, which is of course an immediate term trade, versus what we've been concerned about, which are emerging intermediate term trends. So let's get into that right away on growth slowing specifically. I think that it's really simple, and to change our view from a growth slowing perspective, we'd have to see A, inflation decelerate, which it's not doing, but moreover, the big three signals, and I'll go through them one by one. Number one, I'd have to see the dollar go up as opposed to down. Number two, I'd have to see interest rates break out above our intermediate term trend line of resistance, which is 2.80%, and it has not. In other words, rates from a trend perspective are still going down. And then number three, inflation expectations, as I pointed out, would have to calm down. Obviously, that is not happening. The CRB index for the year to date continues higher, as do things like gold. So those three things are the big things from a trend perspective that I'm really concerned about. Now, in that kind of an environment, there are things that work and things that don't work. I think that when people talk about being bearish, they typically don't know what to do on the long side. Now, that's not how we roll. If we were bullish on inflation accelerating, well, you want to be long inflation assets. If you're bullish on growth slowing, well, you want to be long things that do well in a slow growth environment. So let's look at what's working. Gold, for one, up 7.1% for the year to date. That's kind of the epicenter of slow growth investing. Mortgage REITs up 6.3% for the year to date. Again, as interest rates continue to trend lower, we're not as bullish on rates as we were last year. In fact, I think that interest rates go lower, and I think that that's why REITs go higher. And then finally, utilities. Now, utilities, as you'll recall, much like gold in 2011, started to act very positively to what? Inflation was accelerating, U.S. consumption growth started to slow, the consumer stocks started to not work, and people had to dogpile into utility. So again, that's what's working. It's not the trade, it's the developing trend, and I think that that's a really important point. Now finally, what's not working, of course, is the growth stuff. So again, when growth is slowing, don't be long growth. That includes consumption growth. That's why you can see here for the year to date, consumer staples and consumer discretionary stocks are just getting smoked on a relative basis and an absolute basis, in as much as the Russell 2000 is. Now, many people would be hard-pressed to convince me that the Russell 2000 is not a growth index. Obviously, it is. So almost the direct opposite of what you wanted to be long last year is where we want you to be positioned this year. And you want to be mindful of that stuff. Again, you're long gold, REITs, and Utes. And on the other side of it, you're short or bearish of a lot of the U.S. economy, which has to do with consumption. So that's that. That's why I'm still bearish overall on U.S. consumer growth. We are bullish on inflation. There's plenty of ways to play that too. I'm at Keith McCullough on my Twitter handle. If you have any questions, please tweet me.